I'm going to walk through exactly how MICs and MFTs work, starting with why you should care. Then I'll show you what each one actually is, how their tax treatment affects your returns, and most importantly, what happens to each when interest rates rise or housing markets crash. Most people think earning money from real estate means buying rental properties and dealing with tenants. But there's another way to profit from the mortgage market that most Canadian investors never discover. Read the references in the description below on where this information was pulled from. I am Kane. I've been investing for about 20 years and have properties throughout Ontario. Watch my biography video for my full story. Without further ado, let's get started. These professionally managed pools of mortgages let you collect mortgage payments from borrowers without owning the property. You don't need to fix broken toilets or chase down rent payments, you just collect your share of the interest income every month. Traditional income investments like GICs pay as low as 2.5% for a one-year term, but MICs often target 6 to 8% yields from mortgage interest. That's triple or quadruple the income from the same amount of money. A $10,000 GIC might pay you $200 per year. The same money in a MIC could pay you $700. That extra $500 makes a real difference when you're trying to build income. Higher yields sound great, but why aren't banks offering these returns if mortgages are so profitable? Banks have strict lending criteria that leave gaps in the mortgage market. They want borrowers with perfect credit scores, stable employment, and 20% down payments. They won't lend to self-employed people who can't prove regular income. They reject house flippers who need short-term financing. They turn away borrowers with credit issues from divorce or business problems. MICs and MFTs fill this gap by lending to borrowers who don't meet traditional bank requirements. These borrowers still own valuable properties. They can still make their payments. They just don't fit the bank's computer algorithms. Banks miss out on these profitable loans because they're too rigid. MICs and MFTs step in and charge higher interest rates for taking on these deals. The flow-through tax structure lets you avoid double taxation on investment income. MICs distribute nearly all their income to shareholders as dividends, then deduct those distributions from their own taxable income, reducing it to zero. The company pays no corporate tax on this distributed income. You only pay tax once when you receive the dividends. This structure can provide tax-deferred growth within registered accounts like RRSPs and TFSAs. This contrasts with REITs or dividend stocks where corporations pay tax first, then you pay tax on distributions. A regular corporation might earn $100, pay $27 in corporate tax, then distribute $73 to you. You still pay personal tax on that $73. With MICs, you get the full $100 and only pay your personal tax rate. The dividends from MICs are taxed as interest income. You can hold them in a TFSA, RRSP, or FHSA to shield yourself from taxes entirely. This tax efficiency helps maximize your after-tax returns compared to other income investments. MICs offer a diversified approach by spreading your money across a pool of mortgages. This diversification helps reduce risk because one bad mortgage won't destroy your entire investment. You get exposure to dozens or hundreds of different properties and borrowers. The real question is which vehicle protects your money better when things go wrong. Both MICs and MFTs can lose money if too many borrowers default. The structure matters when mortgages go bad. These aren't just higher yield alternatives, they're your access to professional mortgage lending with tax advantages most investors never discover. But before you invest, you need to understand exactly how these mortgage companies operate and what they can legally do with your money. A MIC is basically a mortgage company that you can own shares in, but the rules about what they can and cannot do might surprise you. When you buy shares in a MIC, you become a part owner of a lending business. The company takes your money, along with money from other shareholders, and makes mortgage loans to borrowers. MICs pool your money with other investors to make mortgage loans, then distribute the interest payments as dividends. Let's say a MIC collects $100,000 from shareholders. They lend this money to a borrower at 8% interest. The borrower pays $8,000 in interest over the year. The MIC keeps a small management fee and distributes the rest to shareholders as dividends. You get your share based on how many shares you own. Here's the catch. They must keep at least 50% in residential mortgages, and while their primary business is lending, they can invest up to 25% of their assets directly in real estate. Section 130.1 of the Income Tax Act sets these rules. A MIC can make commercial mortgages, but residential mortgages must make up half their portfolio. They cannot buy rental properties as their main business or flip houses. They focus on lending money secured by real estate. This 25% cap excludes properties they acquire through foreclosure. MFTs need minimum 20 shareholders and operate under specific tax rules from 1973. The government created these rules to help small investors access the mortgage market. These tax rules let MFTs distribute 100% of their net income to shareholders without paying corporate tax. The company becomes a pass-through vehicle for mortgage interest. The types of borrowers MFTs typically serve include house flippers, self-employed people, or those with credit issues. Banks reject these borrowers because they don't fit standard lending criteria. A house flipper might need a 6-month loan to renovate and sell a property. A self-employed contractor might have good income but can't prove it with T4 slips. A divorced person might have temporary credit problems but owns valuable real estate. Private MFTs have redemption gates, while public ones trade on stock exchanges with daily liquidity. Private MFTs usually let you withdraw money monthly, quarterly, or annually. You might need to give 30 or 60 days notice. Public MFTs trade like stocks. You can buy and sell shares anytime the market is open. When borrowers default and mortgages go bad, MFTs can acquire properties through foreclosure, but their business model doesn't involve long-term property management or renting them out. While they can hold these properties temporarily, they must sell them rather than operate as landlords. This creates limitations when dealing with problem loans that other investment structures don't face. MFTs operate under different rules that give them other options when mortgages go bad. When a borrower defaults on a mortgage loan from a MFT, the MFT must sell the property quickly or write off the loss. MFTs work differently. They can take ownership of the property and rent it out while they wait for market conditions to improve. Mutual fund trusts need 150 unit holders and can invest in mortgages, real estate, stocks, or bonds. They can spread investments across more asset types, including mortgages secured by residential, office, industrial, retail, hotel, and development land properties, as well as secured consumer loans. If mortgage rates drop and fewer borrowers need private loans, the MFT can shift money into rental properties or other investments. This flexibility sounds better, but it also means your MFT manager could shift your money into assets you never intended to own. You might invest expecting mortgage income and find your MFT bought office buildings or shopping centers. The manager might decide to buy stocks during a market crash. You need to read the trust agreement to understand what assets they can purchase. MFTs issue units instead of shares and operate as trusts rather than corporations. When you buy into a MFT, you become a unit holder. The trust structure lets income flow through to unit holders without corporate taxation. Units represent your proportional ownership of the trust's assets and income. The asset seizure advantage means when mortgages default, MFTs can take the property and rent it out or sell it later. Let's say a borrower owes $200,000 on a house worth $250,000. If they stop paying, a MFT must foreclose and sell quickly, maybe for $220,000. A MFT can take the house, rent it for $2,000 per month, and sell when prices recover. This flexibility can protect your capital during market downturns. This approach has worked during previous housing downturns when some mortgage trusts held real estate temporarily. They collected rent while waiting for housing markets to stabilize before selling at better prices. The 150 unit holder minimum contrasts with MFT's 20 shareholder requirement, and this matters for fund size. MFTs typically raise more money because they need more investors. Larger funds can diversify across more properties and borrowers. They can afford professional property management when they seize real estate. Smaller MFTs might struggle to manage foreclosed properties effectively. MFTs are investment trusts with flexible mandates that can adapt to market conditions and seize real estate when mortgages go bad, giving them more tools to protect your capital. They can change their investment strategy based on market opportunities. This adaptability helps during economic stress when one asset class performs poorly. But this flexibility comes with its own set of risks that many investors overlook when chasing higher yields. Several warning signs can help you spot trouble before it destroys your investment. The private MFT space has had cases of fraud, including funds being misappropriated by management for personal use or to fund unrelated ventures. Several mortgage funds went under during previous market crashes. Investors lost their entire investment when these funds made bad loans to risky borrowers or when managers stole their money. If a private MIC is promising guaranteed double-digit yields or quick returns with minimal risk, this should be viewed with suspicion as it may signal potential fraud or a Ponzi scheme. No legitimate investment can guarantee high returns without taking big risks. If a MIC promises 12% returns every year, they are either lying or taking dangerous risks with your money. Real mortgage returns fluctuate based on interest rates and borrower defaults. Any guarantee means someone is covering up losses or planning to run away with your money. Even legitimate high-yield funds can be dangerous if you don't understand their loan-to-value ratios and borrower quality. You need to check what types of mortgage invest in. Some funds focus on safer first mortgages. Others make riskier second mortgages behind the bank. First mortgages get paid first if a borrower defaults. Second mortgages only get paid after the bank gets their money back. Check if a MIC focuses on first mortgages versus riskier second mortgages behind the bank. Second mortgages carry much higher risk because they stand in line behind the first mortgage holder. If a house sells for less than the total debt, the second mortgage holder might get nothing. Many MICs that collapsed were making too many second mortgages to high-risk borrowers. Loan-to-value ratios above 75% increase your risk significantly. A 75% LTV is considered conservative and aligns with the maximum LTV used by most banks. This ratio compares the loan amount to the property value. A $375,000 loan on a $500,000 house has a 75% loan-to-value ratio. Anything above 75% means less equity protecting the loan. If property values drop 20%, an 85% loan-to-value ratio becomes underwater. The borrower owes more than the house is worth. Geographic concentration risk affects funds that lend only in specific cities or property types. Some MICs focus only on Toronto condos or Calgary oil patch properties. If that local market crashes, the entire fund suffers. A fund that lends across different cities and property types spreads this risk better. You want geographic diversification to protect against local economic problems. Management fee structures can eat into your returns even when loans perform well. Some funds charge 2% or 3% annual management fees plus performance bonuses. These fees come off the top before you get paid. A fund earning 8% gross returns might only pay you 5% after fees. High fees are especially dangerous during tough years when gross returns drop. Private funds with long redemption periods can trap your money during market stress. Some funds only allow withdrawals once per year. Others require 90 days notice for redemptions. When markets crash, these funds often suspend withdrawals entirely. You cannot get your money out when you need it most. Spotting these red flags early can save you from costly mistakes, but knowing what to look for is only half the battle. The real work begins with thorough research before you commit any money. MICs offer simpler mortgage exposure with tax advantages, while MFTs provide flexibility to adapt and seize assets, but both require careful due diligence to avoid costly mistakes. Start by researching public MICs and MFTs to understand their current portfolios before considering private offerings with higher minimums and longer lockups. For public MICs, review financial statements, payout history, loan portfolio breakdowns, and any premium or discount to net asset value. For private MICs, examine redemption policies, loan types, geographic exposures, and fee structures. Check their annual reports and quarterly filings. Look at their loan-to-value ratios and geographic spread. The key is matching the investment structure to your risk tolerance and liquidity needs, not just chasing the highest yield. If you like this kind of content, be sure to watch my next video on the detailed explanation on MICs.